Let's go to CommSec though. Tom Piotrowski live for a look at the numbers today. What's your read, Tom? Morning.
Good morning, Pete. We're going to be down by around 0.6% when the market kicks off this morning. That's reflecting the losses that featured on Wall Street at the end of last week. So we had the Nasdaq, for example, down 1.6% and the S&P 500 down 1.2%. The Dow down 0.8%. So there was a lot going on in the Northern Hemisphere at the end of last week, Pete. But basically in the US, there's a pulse of activity which seems to be picking up, and that's reflected in recent economic figures. On Friday, it was the New York State Empire Manufacturing Survey. This is an important barometer of manufacturing activity in the US. It had quite a marked turnaround, and combined with rising oil prices, what you saw is long and short-term interest rates pushed up against their recent highs, and that was what was creating discomfort where stock market investors were concerned. European markets did quite well on Friday, by contrast, reflecting better economic news that we saw out of China on Friday, and so you saw the luxury goods makers in European trade do quite well. In the UK, the market was up by 0.5%. The French market up almost 1%. The German market up by 0.5%. The Stock 600 index up by 0.25%. That's a broader measure of European stock performance. So today, Pete, whilst the futures are pointing to a decline, worth keeping an eye on the commodity-related sectors or mining stocks. You've got a range of commodities at multi-month high, amongst them oil at a 10-month high. That should see energy stocks well supported. Oil was up by about 4% last week. It's trading around $94 a barrel for Brent, the European benchmark, around $91 a barrel for the US benchmark, again up against the ceiling of recent highs. And what that is doing is feeding into inflationary expectations. That's part of the reason why you're seeing those long-term interest rates and short-term interest rates pushing higher. So that dynamic is what's creating a bit of a bumpy ride for stocks at the moment.
Okay. Tom Piotrowski, thank you.